Today, we're unpacking a fascinating personal monetary system that frankly challenges pretty much everything we know about traditional finance. We're talking about the infinite banking concept, or IBC. This is a strategy developed by Nelson Nash, and it completely flips the script on how we manage, store, and utilize our money. At its core, it's a system that requires us to stop thinking like everyday consumers and start thinking like financial institutions.
Now, what if you could actually recapture every single dollar of interest you currently pay out to traditional banks? Think about that for a second. It demands a massive paradigm shift, moving us from this accepted reality into actually becoming the owner of capital. You see, most of us just accept that to buy a house, get a car, or fund a business, we've got to go to a bank, sign on a dotted line, and pay them interest for years and years. But what if you could capture that entire interest stream for yourself? Essentially, what if you became the bank?
Section 1. The Perpetual Financial Headwind.
Let's examine the fundamental flaw in our current system, the one keeping most people locked in what Nelson Nash calls a corporate prison of perpetual debt. The crucial point here is that traditional banks act as massive gatekeepers. Nash famously compared them to the Great Wall of China. Think of it like this. There is essentially one giant pool of money out there in the world, and banks completely control access to it. Whenever you need to finance a major purchase, you have to pass through their gates and, of course, pay their tolls. This subjects you to a perpetual financial headwind where 20, 30, sometimes literally 40% of your hard-earned payment dollars are just going toward interest, enriching those gatekeepers rather than your own family.
And when you really look at it, it's crazy how fragile fractional reserve banking actually is compared to the stability of controlling your own system. Banks aren't even lending out their own money. They take your deposits, toss you a few pennies in interest, and then turn right around and lend that exact same money back out to your neighbor at 7 or 8%. When you rely on fractional reserve banking, you are the one funding their highly profitable system. Infinite banking asks a really simple question. Why not build your own capital pool and keep those profits for yourself?
Section 2. Escaping the Corporate Prison.
Recognizing this trap is only the first step. Actually creating a functional lifelong alternative is where the real magic happens. Instead of constantly fighting that financial headwind, the infinite banking concept creates a perpetual tailwind for everything you do. Nash made a great point about this. He said trying to get a better rate of return on your investments while you're still paying massive interest to banks is basically like trying to make an airplane fly 5 miles per hour faster against a hurricane-force headwind. It's totally exhausting. But if you control the environment, if you control the banking equation itself, you create a tailwind. Your money starts working for you continuously and without interruption.
Now, you might be wondering, what's the actual mechanism here? Well, the underlying vehicle for this system isn't a high-yield savings account or a 401k. It's a specially designed dividend-paying whole life insurance policy from a mutual company. And to be clear, this is definitely not your standard whole life policy built just for a massive death benefit. No, this is structured specifically to maximize your cash value right from day one. And why a mutual company? Because mutual companies are actually owned by the policyholders, not by Wall Street shareholders. So when the company profits, you get paid dividends. It's a real game changer.
Section 3. The Mechanics of Infinite Banking. Okay, let's look at how this philosophy operates in the real world and turns this vehicle into a personal banking system. When you compare 5 different methods of financing a car over a 44-year time frame, the disparity is just staggering. Leasing, that's a pure loss. The bank method keeps you perpetually bleeding interest. The cash method is definitely better, but you keep draining your savings down to zero and totally missing out on compounding interest. But the IBC method, it completely towers above the rest. Because your capital never actually stops growing, the wealth accumulation over a lifetime is absolutely massive.
Section 4. The Car Purchase Comparison.
Let's anchor this with a concrete, everyday example to see exactly how it works. Let's say Jeremy wants a $30,000 SUV. If he goes the traditional bank route, sure, he gets the car, but that $30,000 plus all the interest leaves his family forever. Poof, gone. But with IBC, Jeremy borrows $30,000 against his life insurance policy's cash value. The insurance company uses his cash as collateral. That means his entire original $60,000 cash value stays right there in the account, continuing to earn guaranteed interest and dividends. He gets the car, and his money never stops growing. It's literally working in 2 places at once.
Section 5. The Honest Banker Rule.
Now, with all of this financial power comes a very strict, non-negotiable ethical requirement. Nelson Nash always pointed out that if you own a grocery store and you and your family just take groceries out the back door without paying for them, you are going to go bankrupt, period. Well, taking a policy loan without paying yourself back is the exact same thing. It's essentially stealing from your own grocery store. Just because you don't have to adhere to a strict bank-mandated repayment schedule doesn't mean you shouldn't. To be an honest banker, Jeremy has to pay back that $30,000 car loan to his policy at the same interest rate or even higher than a traditional bank would charge him. That strict discipline is exactly what capitalizes the system and creates long-term wealth.
Section 6. Tax advantages and risks.
Because as amazing as this system is, we have to remember it operates within strict IRS guidelines, specifically the Internal Revenue Code Section 7702. The whole system heavily relies on these specific, IRS-approved advantages that allow your capital to grow and be accessed super efficiently. First, your cash value grows tax-deferred. Second, when you take out a policy loan to buy that car or maybe invest in real estate, that loan is entirely tax-free because legally it's a loan not classified as income. And eventually the entire death benefit passes to your heirs income tax-free. It is an incredibly powerful legal environment to grow your capital.
But here is the catch. If you overfund the policy too fast and cross what's called the MEC limit, you instantly lose those powerful tax advantages. The IRS created this modified endowment contract rule to stop people from just dumping massive amounts of cash into life insurance purely as a tax shelter. If your policy becomes a MEC, your loans and withdrawals suddenly become fully taxable. And that's exactly why you absolutely must work with a professional to design the policy correctly from day one. You do not want to cross that line.
We also have to objectively acknowledge the reality of the numbers here. Policy loans are not interest-free, and managing the spread between loan rates and dividend rates requires extreme discipline. Critics of the system, like the white coat investor, rightfully point out that if your policy loan charges, say, 8% interest, but your dividend rate is only 4%, while you are paying a 4% net spread to access your capital. This isn't just free money. You are paying for liquidity and uninterrupted compounding, so you have to ensure the investments you make with that borrowed money actually outpace your borrowing costs.
So, as we wrap up this explainer, you really have to ask yourself a tough question. Who do you want to enrich the next time you finance a major purchase? Every single time you buy a car, renovate a house, or invest in a business, someone is playing the role of the banker. The math of interest and compounding is happening out there whether you like it or not. So the only question left is, will you remain the consumer fueling the traditional banking system, or will you take control, become an honest banker, and build a multi-generational vault for your own family?